46 years.
3 beloved isles.
1 beloved station, Radio Cayman.
The voice.
The heart.
The soul of the Cayman Islands.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. As a member of the Chamber Pension Plan, depending on your age, you are invested in one of our 6 life cycle funds, each with a different investment allocation and level of risk. But did you know you have the option of choosing a different fund than what you were originally enrolled in? If you are looking for less risk, simply advise your employer to reallocate your contributions. Remember that pensions are for the long term, designed to maximize your retirement funds. If you have any questions with regards to the fund you are currently in or why you might want to change, please contact us at 745-7630 or admin@pensions.ky. The Chamber Pension Plan. We're here for you.
From Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense. I'm Kathy Miller and I will be your host this morning. Now I'm usually behind the scenes for Money Sense and in the producer seat, and we usually have Simon or one of the other regular hosts that are hosting Money Sense, but this morning I will be hosting Simon. I'll be interviewing him, so we're doing a little different thing this morning.
Grilling me, you said, right?
So what did you just say?
Grilling.
Yes. Well, I'm not going to grill you. You know that. But welcome to your own show, Simon, as the guest this time.
Thank you.
You're welcome. This morning we're going to be talking about a couple of things, starting off with the big news from the U.S. yesterday, from the U.S. Federal Reserve increasing interest rates for a second time this year by 0.75%, and how this will affect mortgages in Cayman. That'll likely spill into the cost of living in Cayman. What can we do about that? How can we lower the cost? We're going to look at the current market and the recession, risk or no risk, because I'm hearing there might not really be a risk. So I guess we'll start with the rising interest rates. So in June, the U.S. Federal Reserve increased interest rates by 0.75%. And yesterday, they did the same thing. This is expected to happen 3 more times for the rest of 2022. What does this mean for Cayman?
Well, what it means is that everyone's cost of living is going to go up. And I know we're going to talk about cost of living, but in very simple terms, if you have a mortgage or if you have a loan, then obviously the cost of that is going to go up simply because interest rates have gone up. Now, a lot of people may have been originally on fixed rate mortgages. Sometimes you can be on a 2-5 year fixed rate, but eventually those become variable and floating. And every time the Fed puts up interest rates, the banks put up interest rates. Banks aren't in it. Banks aren't there to be charitable organizations. They're there to make money. So their cost of borrowing goes up. So their cost of lending has to go up by basically the same amount. So everybody's going to find that, or everybody who has a mortgage is going to find that their costs have gone up. And then you start to think about it. Okay, if the cost of a mortgage goes up, what happens next? Well, it makes houses slightly more expensive because your borrowing costs have gone up. But also imagine someone who has a house that they rent out. They've borrowed money with a mortgage, they rent it out, their cost of borrowing has gone up. Well, logically, if they're getting the same rent in, then they might be economically in trouble. So it's possible that rents might go up as a result of that. So there's a lot of not unintended, but there's a lot of unexpected consequences from, or often unexpected consequences from interest rate rises that trickle through to various other parts of the economy because of it. But in essence, it means that costs of everyone's day-to-day living will increase at the same time, as we've talked about, that inflation obviously is prevalent everywhere.
Oh, absolutely. Well, we know that the prime rate in Cayman is 4%. Mm-hmm. And I know during the pandemic, I think the local banks dropped it down to 3.25%. And they had to raise it again, back up to 4%. So now with this increase, it will go to 4.75%. Yes. But I did mention that there's likely going to be 3 more increases for the rest of this year. How much more can that prime climb?
Well, it will climb exactly equal to whatever the Fed does. There's no logical way that a bank in Cayman, which is what sets the prime rate, is going to reduce its margin. No bank globally does that, so I'm not picking on Cayman banks for that. It's just a simple fact that when Federal Reserve rates go up, prime rates go up globally, and they go up by exactly the same amount. So if you expect, and so there's a couple of ways of looking at this. You can say, what does the market think is going to happen to interest rates this year, which is prone to uncertainty, or you can say, what does the Fed itself project interest rates are going up by the rest of the year? So the Fed is at least expecting interest rates to go up another 0.5%. They're saying, almost without any doubt, this year they'll go up another 0.5%. You're right, they're talking about 3 more rises, but they're not going to be at 0.75% each time. They're going to be slightly smaller increases. So they're going to go up at least between 0.5% and 1% this year. So the Cayman Prime there, logically, is going to be well over 5% by the end of the year. And then you think that mortgages...
If it's 0.5% each time, then we're looking at 1.5% from the 4.75 that it's going to adjust to.
Exactly.
Okay.
So it could very easily be 6% by the end of the year, but it's certainly going to be 5.5% within the next 3 to 4 months.
So in knowing that, as a homeowner, what do you do to prepare? I'm not there, so I can't imagine how frightening of a scenario this could be.
Well, so I did some sort of very basic analysis and very basic maths, and if you take the example of someone who gets a mortgage for $500,000, it's a nice round number, so that's why I chose that number. $500,000, you get your mortgage for 20 years. So what does that mean in terms of your costs? So imagine at the beginning of the year, before all this panic about interest rates changing happened, you were paying about $3,000 a month in mortgage repayment, interest and repayment amount. So that's not trivial by any stretch of the imagination, but it is what it is, $3,000. As of today, you're paying $3,600 per month. So that's $600 more per month, which is almost $7,500 more per year.
That's just
as of today, as of the last couple of months' impact. Then if you expect things to go up another one and a bit, you're going to be paying another $200 to $300 per month more. So another $3,000, potentially $4,000. So really, you're talking for someone who at the beginning of the year on this $500,000 mortgage was paying $3,000 a month, is likely by the end of the year to be paying $4,000 a month, which is a substantial change. Obviously, that's almost $12,000 a year. Now, it's true to say that people's wages in Cayman are going up. They're going up a little bit, but that's a substantial increase. If someone were to be earning $100,000, they have to be getting a 12% increase in salary in order to compensate just for their mortgage increase. Someone who's less than that, then clearly they're going to have to be getting an even higher percentage to be able to account for their mortgage costs going up by $12,000. So it's certainly a non-trivial sum of money, and you might one often thinks $500,000 for a mortgage is a lot of money, but actually there's not that many properties in Cayman that are affordable under $500,000, and so that's actually not an unreasonable sort of guesstimate as to what a mortgage might be for a lot of people.
If I'm correct in recalling, I was reading an article in, I think, Real Life Caribbean, the magazine, or is it Real Life Cayman? Anyways, I'll get the name right one day. But in the article, it was citing that a single-family home, like a 3-bedroom home, is priced at around $1 million. So that's what families would be looking at.
Yeah, and so you say, well, perhaps that sort of mortgage then is another 50% more, so it's a $750,000 mortgage. So all the maths I just did, you're saying $1,000 more per month. You're talking, another $500 extra on that, so another $1,500 a month for the average person who has that typical size property with that typical mortgage. So by no means is it going to be pain-free. Now, the important point is that is in itself an important point, but the important ancillary point to this is to sort of ask why have these interest rates gone up? Because interest rates don't go up for no reason. There's deemed to be a logic behind it, and the reason is to stop inflation. So if this is successful in stopping inflation, then the positive news in the long run, short run it's still very, very painful, but the positive news in the long run is that we'll start to see a slowdown in the rate of growth in the likes of fuel costs at the gas pump, in supermarket prices. So hopefully, if these interest rate increases are successful, our cost of living generally will start to become a little bit more manageable, but there's a very, very painful process of getting there, of course.
Has that actually ever really happened? Because in my memory, which isn't always the strongest, but if we go back to...
Well, you're too young as well.
No, but if we go back to 2010, 2012, when or was it 2007 now? I can't remember, when the real big recession hit the U.S., And I don't think the cost of living has ever gone back down. Everything is always, the prices have always stayed higher. The cost of living is always, it's just steadily increased.
So that's true. I think the distinction that's important to make is that absolutely, if the Fed raises interest rates enough and causes a recession, to take your analogy, the cost of living will stop going up. And that in itself is important. So yes, it's as painful as it is that everything's gone up, say 15% or 20% or 10%, whatever that number is, you learn to live with it. Things are never going to go down substantially in price. There's one possible exception. But in general speaking, things are not going to go down substantially in price. But at least if things stabilise and stop going up quite so rapidly, you can learn to live with that a lot easier. When prices are going up each year by 10%, that's a really difficult cost of living adjustment that people have to make.
Right.
If they go up once 10%, it's a very painful short-term adjustment, but you can learn to live with that if they then stabilise afterwards. And that really is the reality of what the Fed is faced. It really would have wished it had never let inflation get out of control, and 10% is out of control. But it is. That genie has escaped from that bottle. I'm mixing my metaphors terribly here. So that's happened.
It's early.
Yeah, quite. That's happened. And now the function that the Fed has to react to is what can it do to stop this getting worse? It can't do anything about bringing prices down unless it were to engineer another Great Depression, a 1920s type of scenario, which absolutely nobody wants. That's the only way it could bring prices down realistically. It has to accept that prices will stay at these higher levels, and we all have to accept that prices will stay at these higher levels, but they won't go up. Hopefully, if this is successful, they won't continue to go up aggressively. Now, oil prices and gas prices may at some point start to decrease, but that's well beyond the capacity of the Fed, because that's influenced by geopolitics with Russia's actions in Ukraine and all sorts of other crazy global world events that are going on.
Right. Okay. That was a lot of information there. Thank you, Simon. So we did get into the cost of living there, right? We do know that it's increasing in Cayman. You did make the point that salaries are increasing a little bit here as well. But we're just playing catch up, really, when it comes down to it.
Absolutely. You're totally right. And in an ironic sort of way, the Federal Reserve and central banks around the world very much hope that salaries don't go up. And that might seem slightly counterintuitive, but
yes.
if salaries go up now by the same amount that inflation has gone up, then that simply spurs future inflation. So what has to happen, and this is an economist sort of nightmare, an economist sort of dream analysis, but a nightmare for real people, but it's the only real way to stop inflation continue to go up is to have this painful short-term shock to the average person so that our salaries don't go up by the same amount the costs have gone up, because then there's a demand and supply imbalance. There's not enough demand, there becomes too much supply, so prices start to stabilise. And that really is what has to happen. So yes, our salaries may start to go up, but globally, if you think in aggregate in the US and UK and Europe where this inflation problem exists, you have to expect people have to be self-reconciling that their salaries are never going to go up as much as the cost of living is gone up. Because if they do, then the cost of living will simply continue to go up at these aggressive rates, and no one can afford to allow that sort of thing to happen. So the only way that central banks plausibly can keep inflation under control is to put interest rates up and to hope that wages and salaries don't go up as much as inflation is going up. Otherwise, things spiral into an unpleasant situation.
Okay. For the cost of living now, there's some solutions in Cayman that are being posed to help reduce the cost of living here. Can you start off by telling us how the cost of living is even calculated and if it's applicable to the average person in Cayman?
Yeah, and it's a really tricky one to properly assess, and it's also very important to other people, because a lot of people say, well, the inflation rate in Cayman is, I don't know, let's say 9% or 8%. It doesn't really matter what the number is. And they say, well, my inflation rate's a lot higher than that. And it's absolutely true. What you spend your money on will be very different to what the statisticians in the government calculate the inflation rate to be, because they can't predict an inflation rate for every single human being. But that's not their fault. That's just the methodology that is done globally to calculate inflation and cost of living. So the methodology is that a basket of goods is selected, and those things are tracked each month, each year, and assessed. So has that basket gone up? Has that basket gone down? And by what amount? So, for instance, if you like tuna, but in their basket they have grouper, and tuna goes up more than grouper, you're going to think the cost of living has increased more than they have calculated. But they can't possibly, it's not just not humanly possible, it's not statistically possible to do a cost of living for every single human being. So they have to take what they consider to be a representative sample. So it is by definition imperfect, and these statisticians get a lot of grief because people say, well, my cost of living's gone up a lot more. And those people might well be right. But I just want to implore people to try and think of it from the statistician's point of view. They cannot create, it's not possible to create a basket for everyone. So it is done well. It is done to global sort of standards, but it inherently has failures and faults. But that's the methodology that is adopted globally. So it really is a global problem, not a Cayman problem in that sense.
Okay, we got to go to a quick commercial break. I love how you were cognizant of the time right there as well. So we're going to go to commercial break, and when we come back, we're going to continue with the cost of living in the Cayman Islands.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. The current pension holiday is set to expire September 30th. Employers and employees will be required to recommence the legally specified pension contributions effective with October earnings. If you have any questions or concerns, please visit our website at chamberpension.ky or contact us at admin@pensions.ky. The Chamber Pension Plan, representing large and small employers in all sectors of Cayman's economy.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense. I'm Kathy Miller, hosting for the first time on Money Sense, but I'm hosting our regular host. I'm interviewing Simon Caudry, and we were just talking about the cost of living in the Cayman Islands, how that's calculated, what does that mean to the average person here, and I want to bring up something that was introduced recently by the Cayman Islands Development Bank. And what they've done is they've introduced a new lending scheme. So they're lending money to qualified Caymanian borrowers with an interest rate as low as 3.75%. Mm-hmm. The mortgage rates on 30-year loans are fixed for 2 years. Government is backing this with $15 million available for the program, and the bank can provide loans of up to $600,000 for each borrower to buy or refinance a home. So my question to you, Simon, is they're bringing down that interest rate to 3.75%. It's a 2-year fixed rate. Mm-hmm. To me, that seems a little short, almost as if, let's entice you to bring you in. Is this a good move for the qualified Caymanian borrowers or not?
Well, this answer needs to be caveated to start with. Let me caveat it this way. If you are somebody who is in the process or about to buy a property, you've decided that you're buying a property. Mm-hmm. I'm not going to talk you out of buying a property. You've just decided. That's the person who's decided. Then you should go to the Cayman Development Bank and bite their hand off and take all the money you can get from them, because that is a ridiculously good rate.
Okay.
So there is absolutely no question. If you have absolutely decided you want to buy a property, go and take that interest rate. It is good. Now, you say 2 years, it might be too short. That's an interesting point. I guess the way I'd look at that is certainly by the end of the year, well, already now, commercial rates are much higher than that. And the commercial rates by the end of this year are going to be much higher than that, and early next year are going to be much higher than that. In 2 years' time, depending on how big a recession or how aggressive or how substantial a recession the central banks around the world have actually engineered, we might find interest rates falling again. So you might be able to find yourself in 2 years to be able to re-engineer yourself into a situation to get broadly about the same sort of interest rate. Oh. But you should also be prepared, and this is the way the caveat comes in, you should be prepared to find yourself in 2 years paying more, because clearly if the recession or if a slowdown that is engineered is not an aggressive slowdown, then interest rates are going to be, generally speaking, higher in 2 years' time than they are today. So you might find yourself, okay, you buy at this rate, and you might find yourself paying 1.5-2% more in a couple of years' time. So you have to be prepared for that. You have to budget for that. Now, the caveat that I would throw into this is buying a property at this sort of time a good idea? Well, that's a different sort of question, and I don't. That's the whole load of nuance has to go into that, because there is There are many sorts of debates about that. Interest rates going up generally causes property prices to stabilize or go down. So there's a question there. But as I say, if you have decided that you want to buy a property and you're committed to that, come what may, then that's a damn good rate.
I almost want to cheekily ask, do we really think the property prices are going to come down in the Cayman Islands? We have a phone call, so whether you want to answer that
it's in a pure economics perspective, when costs go up, prices generally... when cost of owning something goes up, the price of the thing that you're owning generally goes down. But Cayman's property dynamics are so far removed from basic economics as to make that analysis almost impossible, because there's so much demand from foreign buyers, there's so much demand from buy to rent, buy to lease. So I just don't have a good answer to that question, frankly.
That's all right. We do have a phone call.
Go on.
So let's take that caller. Good morning and welcome to Money Sense.
Good morning to you, your host, the host and the guest host. Who's the guest?
Thank you.
Just two quick questions. I wondered, first of all, if the show is ever repeated, maybe in the evening sometimes, because obviously a lot of people have to pop into work and can't finish listening.
Yep.
And the second question is, as you said, Cayman's economic model is far removed from most of the world. So bearing in mind that the minimum wage is ridiculously low for years, the cost of living is going up by the day. How would that bad situation, as many would say, mesh into what you're describing with the increased cost of interest rates and increased cost of living that will accompany that? How can we balance that and survive and keep going forward?
Yeah.
Seeing that you were on a bad footing from before this.
Yeah, fair enough. Well, let me answer your first question first, because that's very, very easy. This show is indeed, it's not quite rebroadcast on Radio Cayman, but it's stored, or I think that's the right word, stored on YouTube. So anyone can watch this show on YouTube at any time. Just type in Money Sense into YouTube and you'll get various copies of the show on there. To answer your second question, I think I don't know if you're alluding to this as such, but I think it's very difficult for government policy to solve cost of living crises. You're absolutely right, and we've talked about this. There is a cost of living problem in Cayman, but it's not just Cayman. There's a cost of living problem in the US. There's a cost of living problem in Europe. There's a cost of living problem in many, many countries around the world. But it's a cost of living problem that's affecting the poorer end of the community. The higher end of the community, more wealthy I mean by that, is not really suffering a cost of living crisis because they're incredibly wealthy. The poorer spectrum of the community is seeing the costs that they are spending almost 100% of their income on going up by a substantial amount, and they're not getting an awful lot of additional income. Now, so you mentioned the minimum wage. Now, generally speaking, economists dislike minimum wages because the argument is they can put people out of work because of costs. Employers may not be willing to hire people at those sorts of wages. There's still some debate in the economics community about that, but that's not really a good solution to a cost of living crisis, because it's a slow-moving beast. Putting up a wage amount from X to Y takes time to have some sort of impact. It might mean that fewer people are employed in the short term. It might mean that certain work is outsourced to different countries. So it will have many unintended side effect consequences for doing it. So the honest answer to your question is that Cayman doesn't really control its own economic destiny. And what I mean by that is Cayman doesn't set its own interest rates. Those are set by the Federal Reserve. So the interest rates in Cayman may well be appropriate. They may not be. Perhaps Cayman interest rates in an ideal world should be higher, should be lower. It doesn't really matter. What I'm saying is that we don't set our own economic destiny. The US sets it for us in terms of its cost of living, because we import everything from the US. So if stuff in the US is going up, we're importing that plus the cost of transportation. If interest rates are going up, we're importing that. So we don't have the ability in many respects to control things. Now, I know that there was another recent government policy announcement a couple of months ago, which I think takes effect this month and next month, this fuel subsidy.
Yes.
And that's I might get slightly angry about this, because I think that's a absolutely terrible economics policy. I mean, whoever designed that in government should be fired, because it just makes no logical sense. Because what it's saying is that we are paying a
can't believe you just said that.
No, it doesn't. Well, let me explain why. We're paying a subsidy to people who own $5 million condos on 7 Mile Beach. Mm-hmm. We're not helping. We are arguably helping people who are on low income, but every dollar of subsidy that goes to someone who's earning $5 million and owns a $10 million condo on 7 Mile Beach could much better be engineered to pay a bigger subsidy for people on lower incomes. What this subsidy does is it subsidizes rich and poor people to exactly the same amount. Now, that is an economist's worst nightmare, because it is entirely regressive economic policy. It just makes no logical sense. If you're trying to support people on low income who have very difficult economic circumstances, don't give half the money to rich people. There's no logical basis for it. It might look good political theatre, but I'm afraid to say it's just terrible economics.
One thing that always struck me was that for our electricity providers, they're paying 25 cents, I believe it is on the gallon on the import. So, and that's controlled by the government.
Yeah.
So the government sets that rate. So my thing was, well, if there's something really truly set to help us, wouldn't that import duty cost go?
Well, so there's another. I haven't quite finished my rant then on this. You've spurred me to another point on this subsidy. Because on the one hand, we're all trying to say, or governments around the world are trying to say, we're environmentally friendly. And then we reduce the cost of diesel power. I mean, square that circle, impossible. So the idea that you can solve a short-term cost of living crisis by this sort of short-term fix, it's just not plausible, because people also have to drive to work. Those costs have gone up as well. People have to eat in the supermarket. There are much better economic ways to target support to people who need it than a broad brush policy such as this.
What are some of your ideas?
Well, I mean, people during the COVID crisis, people had to apply for government support. They had to demonstrate they had low income, and they got subsidy. They got stipends and such like.
But a lot of that was also manipulated.
Right.
I mean, that's going to happen.
Yeah, absolutely. But how many people with a $10 million condo are going to apply for a $1,000 fuel rebate if they had to apply? No one's going to. They're going to say it's not worth my time. But that $1,000 they might have got could far better be directed. So I totally agree with you that many government policies, I'm not picking in Cayman here, government policies around the world are prone to manipulation and fraud. And this is one of the reasons why sort of right-of-centre politicians say less government action, because they worry about how it's badly misused. But if you're going to try and target support to people who are on low incomes, then give the support to people on low incomes. Don't give the support to people on high incomes. I mean, that seems fairly logical from an economics perspective. But yeah, I think the other thing, but this is a much longer term problem. There's just no competition in Cayman. That's the reality. We have one electricity provider, we have two telecom providers, and we have no regulation of that. I know. I read in the paper, I think a couple of days ago, that one of the telecoms providers was very excited to be announcing that they're going to bring 5G to Cayman. Well, I remember asking a former government minister a couple of years ago on this on the radio show what the process was to require government licenses to buy these airwave spectrum, and we don't have one. There is no regulation. The UK and the US have raised billions and billions and billions of dollars auctioning airwave spectrum. Cayman doesn't. We give it for free, in essence.
We got to wrap it up, Simon.
No competition. That's the longer-term solution to a cost of living crisis.
We didn't even get to go into the recession, which I was going to ask is going to happen or not. So, the time flies by on Money Sense.
Especially when I'm angry.
I kind of want you to wrap the show up. But what I know is that if you got your questions, anything you want to say, you can tweet us at Money Sense Radio. And I'm going to let Simon wrap it up. Anything you want to let the listeners know if they want to get in touch with you or anybody else?
No, I think, look, by all means, send any questions into Radio Cayman, and we'll absolutely try and deal with those on future shows. And as I said to the listener, YouTube is where the show is stored. So if someone wants to replay it, by all means, go onto there. And thank you.
Go onto our Radio Cayman channel on YouTube, and actually all our talk shows are replayed on there.
So type Radio Cayman.
You do have a podcast as well with the CFA Society Cayman Islands. So the Money Sense shows are also distributed with that podcast.
Exactly.
So, all right. Thanks for listening, and we'll be back with you in 2 weeks.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. As a member of the Chamber Pension Plan, depending on your age, you are invested in one of our 6 life cycle funds, each with a different investment allocation and level of risk. But did you know you have the option of choosing a different fund than what you were originally enrolled in? If you are looking for less risk, simply advise your employer to reallocate your contributions. Remember that pensions are for the long term, designed to maximize your retirement funds. If you have any questions with regards to the fund you are currently in or why you might want to change, please contact us at 745-7630 or admin@pensions.ky. The Chamber Pension Plan. We're here for you